Hello. In this video, we're going to be discussing a moving average, also referred to as simple moving average. They are probably the most common technical indicator that traders will use. They are also insanely simple, but do not let the simplicity of a moving average fool you. They can be very powerful. At the same token, there's no one indicator which is a holy grail, and moving averages do not fall into the holy grail category either. But they can be very powerful. It's something you should almost always have on any chart, anything you're ever looking at. They give you some type of guidance of what's going on with the stock, with sentiment, and so forth. Or I shouldn't say just stock, with the price, because they can obviously be used on futures and indices and you name it. So what you have before you is a kind of a pretty common chart that has two moving averages, and I'll explain later why you have two. This green line is what's called a fast moving average. It's 9, in this particular instance, it's 9 periods. And then this red one is a slow, which is 20 periods. Now, the number of periods doesn't, you can try and you should try a lot of different things to see kind of what works depending on what you're studying, because different stocks are going to act different, or futures or whatever. So essentially, different instruments are going to trade different. So you want to experiment with different moving averages. As far as the math behind a moving average, so let's take this particular candle right here. And so when I say period, so I said like this green line is 9 periods. What I mean by periods are candles. And in this instance, I have a daily chart, but this chart could have been a 1-minute chart, in which case it's going to look at 9 1-minute candles. This happens to be a daily, so it's going to look at 9 daily candles. So when you talk about the period for the moving average, it's actually the number of candles. So in this instance, we're saying that this is a 9 period. So this value right here for this moving average is going to be based off of 1 candle, 2, 3, 4, 5, 6, 7, 8, and 9. So these 9 candles are going to basically, are the closes of these 9 bars are equate to what that value is. The average of those 9 closes is what that value is right there. Now, as we come into this next candle, what's going to happen is now this close is going to be counted, and this one fell off because we're only going to go back 9. So here we had gone all the way back to these 9. In this instance, we're going to move forward 1, so we're going to end here. And what you'll start to see is these big candles really moved, because these were big closes. They really moved that average, kind of shifted it down. But as we start to move forward, these candles fall off, and you can see that actually price starts to level off and eventually actually starts to go up. So that's just kind of the basic nature of how moving averages will work. Now the question is then, what do you do with these things other than have nice colorful charts? The most common thing to use is what's called a moving average cross, and that's where a faster period moving average crosses over a slower period. So if we look right here, right around here, we have the fast below the slow, and that indicates that we had either essentially a trend change or just an end of a trend change. So, and then because of that cross, that basically tells us if we were, say, we were long this product right here, or so we were long. Actually, I'm highlighting something you're not seeing on the video. If we were long over up in this area, and then all of a sudden we had this cross, that tells us to get out of that position essentially, or it can tell us to maybe short that particular product. But the thing that you want to be careful of is sometimes these can be kind of late. You had 2 big candles right here that really moved price down, but it took the end of these 2 candles to finally get this fast moving average to cross below the slow. So if you waited for that, you may have said, you know what, I'm going to go short here, for example. Maybe I want to use a cross to short the market, and that could have been kind of painful for you. In the long term, sure, that would have worked out. Or if you were long and you decided just to go flat, you would have missed this, this section. You would have questioned if you should have just stayed long. But then over here, you would have been happy that you actually that you went flat. So that's one way that you can use moving averages as far as to either sell short or to get out of a position. And the opposite is true if you want to try to understand maybe when you should go long or maybe cover a short. In this case now, the fast period crossed above the slow, and you can see the price starts to trend a little bit higher. Not a huge move, because now you're going to go lower again, but it starts to give you some type of guidance. So like I say, play around with different moving averages, different periods, try it. This happens to be a 9 and a 20, so there's a difference of 11. You could make them really close. You could do a 17 and an 18, or you could do a 5 and a 100. Just play around with it, both to learn and then also just understand how your particular instrument that you're trading, what type of moving averages work best to kind of indicate what's going on with price. The last thing that I want to point out, though, when it comes to moving averages, this particular one, we're saying it's a fast period. It's 9. In this particular instance, is 9 periods. If the shorter you go, so maybe you go down to 3 or 4, what's going to happen is this is going to move really quick. So as soon as you get like a big swing like this, big drop in price, this moving average is going to turn really fast. But you're going to get some false signals where all of a sudden, like maybe right here, you got this big move lower. That moving average, if we had like a 2 period, it's going to drop really fast. But then all of a sudden, price just changes. So you're going to get some false signals. So be careful of that. With a fast period moving average, you're going to get your early warning that we all want. We want the earliest warning we can get. But that's going to come at the price of false signals. On the other side of the spectrum, if you with a slower moving average, the greater that is, the slower the warning, and nobody likes to find news way after the fact. So that's the negative to having a big number of periods in your slow moving average. But the benefit to doing something like that is you're really not going to get false signals. So like everything in life, there's kind of a trade-off, between, in this particular instance, the warning time that you're going to get of some change in trend versus the signal quality, if you want to go with that. So play around with moving averages. Definitely put them on your charts. They do make them look colorful. There's no question about that. And you can pick whatever colors you want. But more so just to get a sense of just what's going on with price, what's going on with trends, and play around with it, learn from it, and hopefully it will make you a better trader. So happy trading, and as always, thank you for listening.